Good evening and welcome back to Be Rich. The news from the world is very somber. Whichever part of the world I turn around, the news is that inflation is going through the roof. And inflation in United States is at 8.5%. In continental Europe is 7.5%. And inflation is even surging in Australia and New Zealand. In fact, New Zealand last week unexpectedly raised rates for another time. All this means that the consumer is hurting. It is not possible to manage budgets to such an extent. Several surveys in Europe and in United States have shown that consumer confidence is shrinking and shopping at retail has dropped because people want to conserve cash because they do not know how high prices are going. And prices which started with used cars because there was a chip shortage has now gone to other products. The Russian Ukraine war has meant that prices of food articles have gone through the roof, especially wheat and edible oils. This is really putting pressure on the household budgets because if you look at reports coming from Europe and America itself, you will find people are now cutting back on what they are consuming because they can't simply afford it. Also, what has happened is wages have gone out of control. Like even the Kamala Harrises of the world were asking for a $12 an hour minimum wage. Today, Amazon claims that it cannot find people at $15 an hour, even if they are willing to give jobs. There are more service jobs, but no takers. And also, as I have mentioned in this channel, Amazon and Starbucks have decided to unionize at the margins. All this is because they believe, as I pointed out, they are not getting a fair share of the money from the owners of the company. All this means inflationary expectations are rising. What is inflationary expectations? Inflationary expectation is what you expect prices will be at the end of next year. And therefore, it is normal that your spending patterns are now determined by that. And because of that, your demand for wages will also go up, and people will demand more and more wages for doing the same job. Once that happens, then a deep recession is the only cure for it because interest rates have to rise. And inflation is a friend of the rich and an enemy of the poor because inflation is an invisible tax that government levies to make sure that its debt levels become manageable. And when inflation, more money chases the same amount of assets, and therefore the value of the hard assets keep going up. Therefore, those who already own assets, hard assets such as gold, in case of Europe and America, real estate and stocks have profited immensely over the last 3 years. Even the tightening of rates only will lop up a portion of the profits and not wipe it as a whole. How should one invest to conserve capital in these times of difficulty where it is becoming very difficult to survive? First, you should shop around among various places to find which bank or institution gives you the highest rate of return for keeping cash. It is very important that one does not get locked in into putting money in a fixed deposit. You may lock in on a fixed deposit for more than a year and then suddenly to your charge and find out 6 months down the line all banks have increased interest rates and you are losing out. And the fear of losing out and the pain of a loss is doubly more painful than the joy of making the same money. So you should be in a position where you don't lock up your capital for long term. That means term deposits and fixed deposits for a duration must be avoided. It is better to stay in cash. I expect as the inflation hardens and central banks are begin tightening, gold will make a correction. How far it will correct depends on how much the Fed tightens. So as gold drops, one can acquire gold if he is risk averse. Stocks have been overheated for several years now, and therefore one expects that stock prices will drop. And as stock prices begin to correct, one should acquire some mutual funds. The immediate question is which mutual fund should you acquire? These people should invest in mutual funds and in stocks only if they do not need this surplus capital for at least 5 years. Even a mid level fund which does not have great results will beat the returns provided by banks in a checking account or in a deposit. Therefore, a portion of our money should be invested in funds. You should look to invest in a passive index fund and also some money in some passive sectors which will benefit because of this impending rise in interest rates. But one should not venture into buying specific stocks unless one has expertise in identifying the stocks or is known to somebody personally who can identify a good stock, and you should be willing to be staying invested at least for 5 years if you want to make an investment till the business go adjust itself to one down cycle and an up cycle. The most lucky ones are those who are practicing professionals because their fees can be adjusted along with inflation. Your doctor will increase his fees, your lawyer will increase his fees, whereas you and I cannot do it. Thank you for watching. Be rich. If you like this video, kindly hit the subscribe button and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. If you like this content, kindly share it with your friends and relatives. Once again, I thank you for supporting Be Rich. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.